talking about the One Big Beautiful Act, OBBA. This is a general overview module. We have other modules that'll drill down on a couple of the specifics covered here. This module is intended just to give you a basic overview. The One Big Beautiful Bill Act is a very, very large piece of legislation. It's not quite as extensive as the Tax Cuts and Jobs Act was, but it is nevertheless very, very large. So we tried to break down some of the essential parts that apply to most folks, and so they can take a look at different aspects and different peculiarities of their unique tax situation. So the major highlights: the Tax Cuts and Jobs Act. The tax cuts were made permanent, meaning they were extended from what they were previously, because they were set to expire in 2025, or sunset, if you will. They've been extended, or they say made permanent, but that is until Congress decides to change them later. So this does not mean that they're going to be this rate for forever and ever. So nextly, the standard deduction was increased, and that's just on inflation based on what it was last year. One of the bigger changes is they had a state and local tax, or the SALT cap, which before was at $10,000, has now been raised to $40,000. We'll talk about SALT in just one second. But remember that $40,000, it doesn't matter if you're single or you're married. The SALT cap is still $40,000 from $10,000, but there is also a phase-out range. So don't just assume that all of your state and local taxes are going to be deductible. Your income may preclude that. We'll talk about that more in just here on one of the further slides. And the estate and gift tax exclusions were increased and made permanent in the same way that the tax brackets were. So there was some angst or anxiety from folks on the estate tax exclusion being reduced dramatically in 2020 at the end of 2025. Well, that fear has been allayed, because now the estate and gift tax exclusions are now quite large, and if you marry them up for married couples, I believe it's in excess of $30 million, which, again, there are many folks who will be above that number, but again, the vast majority of folks, that will not be a significant factor. Okay, so the tax cuts are made permanent. So what does that mean? Inflation, not great for everyday expenses, but for tax brackets, they've inflated along with the inflation rate. So now more income than ever will be able to flow through the lower brackets of 10 and 12%. So what does that mean? For Roth conversions, there's going to be more bracket room available, especially if you're a retiree, to fill those bottom brackets with either income you're going to realize for your living expenses or income you're going to convert to Roth. Historically speaking, the 22% and the 24% bracket are still very, very wide. So on a historical basis, 24% is a very low rate. So depending on your situation, Roth conversions, if you're past your working years and you're looking to convert tax-deferred money to Roth, those opportunities are still going to be available to you. For deferrals, because the 10 and 12 and 22% brackets are going to be wider, if you have an option between making a Roth deferral or a tax-deferred deferral, then there may be some decision making there where Roth may actually make more sense. And then also too, this post-tax deal. So this is a great tool if you are sitting on a large either cash reserve, or you have a lot of money in a taxable account and you have a way to get that into the tax-free bucket via a post-tax contribution to your 401k. It's a great opportunity to get money into that tax-free bucket. Okay, moving on to estate tax exclusion for 2026. The base exemption is $15 million per person. Like I said, there is with a couple, that's $30 million. Again, when the first of a married couple passes away, unlimited amount of assets can pass to the surviving spouse. But $15 million per person is $30 million essentially when it starts to go down to your heirs or other folks to whom you want to bequeath your assets. $30 million, very, very, very large. So if you're going to be significantly below that, state exemption, not much of a concern. If you're going to be above that, then there's some things you can do that are beyond the scope of this discussion that certainly we'd be happy to discuss with you. But in any case, regardless of what the estate tax exclusion is and what you think your estate is going to be worth when you pass, if you don't have a coherent, cogent, up-to-date estate plan, the best time to do it was yesterday. But in the absence of that, today is the best time to look at starting and getting your plan in place for your estate. So again, if you haven't done that, estate planning is what Rosanna Asset Management always leads out with. So if you haven't done that, please contact us and we'll get going on your estate plan pronto. Okay, standard deductions. So for the single person in 2025, it's $15,750. Married filing joint, $31,500. If you're above 65 and single, then you get another $2,000. If you're married filing joint, you get $1,600 each, or $1,600 per person if there is a 164 and one is 65. So a max of $3,200 there. Now, in what's new for 2025 is there is an extra senior deduction of $6,000 per person. This is in addition to these numbers here. Now, you may have listened to, read, heard that being thrown around in the legislation for the OBBA was that Social Security was going to be tax-free. That's not what the legislation says. But this $6,000 extra deduction was supposed to reduce the impact of the 85% taxability on a maximum basis of Social Security. It doesn't eliminate it, but it definitely reduces it for folks who are going to be in that situation. So the $6,000 per person is a huge deal for folks who are already on Social Security. Okay, so for an example of that, we'll assume both people in a married couple are over 65. So this year, or in 2024, you'd have gotten, I think the deduction is slightly less than this. You would have got $31,500 plus the $3,200, or $34,700. But in this year, 2025, they're adding $12,000. But there's a caveat. For the $12,000, this begins to phase out when your income goes above $150,000. Okay, so above $150,000 up to $250,000 when you're married, there's a phase out of the $12,000, not of the standard or the extra. So if you're mainly on Social Security with an RMD, your income is probably below $150,000. If you're married, then you'll enjoy this extra standard deduction here. What does that mean? Well, Roth conversions, realizing more income. There's a lot of things that come into play when you have this large of a deduction, standard deduction, collectively when you're 65 or over. So now is the time to start working with your CPA to optimize your optionality here with that this extra deduction gives you in your tax planning. All right, state and local tax. So it was increased to $40,000. Again, this is for married and single. So it's not $80,000 if you're married. It's $40,000 total, married or single. Okay. Big caveat. There's a phase out. Beginning at $500,000 up to $600,000, that $40,000 starts to phase out to no less than $10,000. So if your income jumps above $500,000 and you don't do anything to affect that, then you're going to lose this deductibility of your state and local taxes. So what does that mean? If your income is going to be tickling that $500,000 mark, definitely start doing some planning, because you may be able to prepay taxes potentially. You could make contributions to retirement plans. You could defer income into the next year. There's a lot of things that you could do so that your income stays below that $500,000 limit, and you want to enjoy the state and local tax deduction. So who's this a huge player for? Well, if you have a mortgage on your house where you've not been deducting your mortgage interest, then this is the time to look at this, because if your mortgage interest was less than the standard deduction, because your state and local taxes were cut off at $10,000, and you're in a high tax state, think California, New York, Virginia, Maryland, those type places, your SALT deduction may bring you above that standard deduction. Okay, And again, you can fold in, we have a charitable module that we're doing as well that can fold into this type of situation as well. So this is, again, an opportunity to work with your CPA or your financial planner so that you're optimizing all the options available to you with this new legislation. But with this, expect more people to itemize because of this SALT increase. All right. So in summary, the Tax Cuts and Jobs Act's tax cuts were extended. The standard deduction was made higher, especially if you're over 65. SALT cap was also made higher as well. Then the estate tax exclusion was made permanent, meaning it wasn't going to expire in 2025. And then, as always, if Roth conversions, Roth in 401k deferrals, and all, if you're not crystal clear on what you want to do with your with that part of your financial plan, again, this is a time to reach out to your CPA or your financial planner so that you can optimize those options for yourself. Okay, if we can be of assistance for this, in addition to this module, we're going to have a specific module on small business and also on charitable giving. There were some pretty big changes in the OBBA for that were beyond the scope of just a generic overview. So if we can be of assistance on your tax situation or your financial plan or your estate plan, please contact us and we'll have a complimentary introductory call to discuss your unique situation. Thank you for the time, and we hope to hear from you soon. Thank you.